So I thought it'd be fun today to talk with you all about mortgage rates and the four most commonly asked questions that I get about mortgage rates. Well, simply put, your mortgage interest rate is the interest rate you're going to pay on your mortgage loan. It's the rate that's used to calculate your monthly payment and ultimately the total amount of interest that you will pay over your loan term. Simple enough. But did you know your interest rate is not the same as your APR? The APR is your annual percentage rate, and it's meant to give you a broader measure of your total cost of borrowing. The APR on a home loan is typically higher than the interest rate because it includes certain costs in the calculation, whereas your interest rate only considers your interest charges. Well, there are many factors that are considered when determining your interest rate on a mortgage. Credit score, loan term, loan size, property value, property type, occupancy, time needed until closing, and other factors all impact your rate. Now you see why there is so much fine print when you look at mortgage rates online. With a fixed rate mortgage, your interest rate stays the same for the life of the loan. With an adjustable rate mortgage, your rate may change periodically. There is no one size fits all solution, but be sure to consider not only the number of years you think you will keep your property, but also the number of years you think you will keep the loan. For example, you may not want a 30-year fix today if you think you're likely to refinance in the next few years. Look closely when comparing. ARM rates are not always lower than fixed rates, and long-term fixed rate mortgages are not always the right solution either. Everybody wants the best rate. First, make sure your credit is in tip-top shape and ask your mortgage loan officer if there is anything you can do, credit score-wise, to improve your loan terms. Also, make sure you understand all the factors impacting your mortgage rate and adjust where you can. For example, many people feel like a higher down payment is always better, but in some cases, your interest rate can actually be better with a lower down payment. Next, ask about shorter lock terms and buy down options. Lastly, keep in mind that rates are market-based and can change without notice. Make sure your loan officer knows how to watch the bond market and can give you good advice on when to lock and when to hold. I hope you found this information helpful. Understanding these key points will help you make a more informed decision when it comes to your mortgage. Stay tuned for more tips.